Saturday, October 17th, 2020, Maneco 64, home of alternative economics and contrarian views. Today, we're going to be looking at Libor and the so-called Big Bang that's happening as we speak. I think it's always very important to know what things mean, and that's why I'm going to go over the term Libor, and it goes back to the 1960s. It goes back to the eurodollar market, which has nothing to do with the euro currency. So for that, I've got an article here from financetrain.com. It says a euro currency deposit has the essential characteristics that the bank receiving the deposit must be resident outside the country of origin of the currency. So it's got nothing to do with the euro. This has been going on much longer before the euro. So it says here, for example, US dollars deposited with a bank in London are euro dollars, regardless of whether the depositor resides inside or outside the US. An organization wishing to borrow yen, for example, could borrow on the Japanese domestic money market from a Japanese bank, or in the euro currency market, for example, by borrowing yens from a bank in Paris. So that's euro yen. This is the interesting part here that we need to know, especially for the dollar. It says, until the late 1950s, US dollars deposited with banks outside the US were quickly repatriated because the banks taking the deposits invested the money in the US money markets. From the late 1950s, however, as the dollar superseded sterling as the main international trading currency, the demand for US dollars by non-US residents increased. Dollars deposited in Europe were increasingly lent to borrowers in Europe, and the eurodollar market grew. The supply of eurodollars was increased by the US balance of trade deficit in the late 50s and early 60s, which created a flow of dollars into the hands of non-US residents. So Libor is the London interbank offered rate. That's the rate that banks lend to each other, dollars to each other outside the United States. And London, of course, is the center of foreign exchange trading. You could have, I guess, eurodollars trading in Paris and Frankfurt, but the bulk of it trades through London. You've also got euro sterling. And as you saw, you had euro yen, you had euro Deutschmarks before the euro. So that's where Libor comes from. And why is Libor so important? Well, because over the last few decades, we've seen the derivatives market evolve, financial derivatives especially. It's mushroomed into the quadrillion in terms of notional amount, and that's the size of the contract, of course. That's 1,000 trillion. Some people argue that that's lower, that's like 600 trillion, but I would say it's north of 1,000 trillion or a quadrillion. And a lot of these derivatives contracts, especially the over-the-counter contracts, they use the Libor rates as a reference. So, for example, let's say a big multinational corporation with billions of dollars outside the US. They'll call Goldman Sachs London, for example. They'll ask the swap or derivatives dealer there, can you write up a contract for me? I've got these bonds. I want to swap out of them, and I want to do it for 6 months. So the Goldman dealer will say, well, that will be 6-month Libor plus 50 basis points. So you can see that all these derivative contracts, a lot of them are based on Libor rates, and they can be based on other currencies as well, of course. And of course, the maturity or the term of these contracts can be anywhere from a month to a year, and they can keep rolling it over after it's finished. And they always adjusted to the Libor rate, which is quoted in the month, 3-month 6 month, or a year. And Libor is usually unsecured loans amongst the banks. It's unsecured. So during the 08-09 financial crisis, when Lehman collapsed and when all the other banks were going to collapse, and they were saved, of course. But before they were saved, no one trusted anybody anymore. And these Libor rates spiked to like very high rates, probably double digits. But it was manipulated, and they actually lied about the rates. Let's say the real rate was probably infinite because they didn't want to lend to each other, but they still quoted 1 or 2%. And apparently the Bank of England was involved in that. So that was a big scandal, that they manipulated Libor to keep a semblance of normalcy while the banks were collapsing. So the regulators, after the dust settled, decided to phase out Libor. But the problem with Libor is like using, for example, the analogy would be in the United States, people use pounds to measure weight or miles for distance and speed. It's like asking people to change or phase out a reference or something that they've used and they're familiar with. So it's been very hard to get the bankers to phase out using Libor and using, for example, the major dollar substitute is called SOFR, SOFR. It's secured overnight financing rates. And the difference between SOFR and Libor is that SOFR is secured and Libor is unsecured. So that's the other thing as well. I think what I've told you so far will help you understand what's going on. But if you want a more in-depth analysis of this Libor, let's say, phase out that's supposed to happen by the end of next year, I recommend a video I did on February 16th this year. It's entitled Libor Risks Disrupting 400 Trillion Derivatives and Loan Markets. Yeah, it's not just derivatives as well. It also helps set reference rates for mortgages everywhere around the world, even in the United States, even though it's dealt in London. And that's why London is such an important financial center. So in that video, I said, in the description, I said, today I look at the progress or lack thereof being made by financial institutions in phasing out the Libor benchmark interest rates. Even though the use of Libor is supposed to be phased out by the end of 2021, according to the Financial Times, Libor underpins as much as 400 trillion of products around the world, from loans to derivatives contracts. And I would say it's probably more. Regulators like the UK's FCA, the Bank for International Settlements in Basel, and the president of the New York Federal Reserve have been warning the phase-out needs to accelerate, and that the market's continued use of Libor poses risks to market stability. I will also give my opinion on how the troubles in the repo market since September 2019 could be related to the Libor phase-out. So if you've been trying to get out of the system as much as possible, and by that I mean not having too much money in the banks, stacking precious metals outside the system, and that's what I've been telling people that I think they should do for the last 4 years, not just since I made this video about Libor. You shouldn't be worried about what might happen to the banks. So we could see accidents, of course, not because changing from Libor to SOFR or other references is dangerous. The danger is that there's so much derivatives exposure out there, trillions and trillions, that you could have accidents. The analogy again, let's say the Germans, who are known to drive very fast in their autobahns. I think sometimes they don't even have speed limits. Let's say overnight they changed from kilometers to miles. You could have a few bad accidents on the German autobahns, right? So this is the same thing, and they've been trying to phase this out for years. And people don't like changing things, and that's why the bankers haven't changed it. And we could see troubles. And who knows? Maybe the whole 2020 crisis is been used as well as a cover for the troubles in the derivatives market. It's a very good way to hide the real truth of what's going on. I wouldn't put it past the central banks that all the QE they're providing helps the liquidity of the banks, helps cover up losses from trying to phase out Libor, I would say. And is it any coincidence that the central bankers, especially the Federal Reserve as well, as we've seen, are now calling for even more fiscal stimulus? What does that have to do with Libor? Well, that would mean that the Fed would be able to provide even more liquidity to the markets by buying treasuries, and that could help cover all the losses that we could see from this transition or phase out of Libor into other references. So I know Lynette Zhang has been speaking about this, and a lot of people have been asking me. So there's an article here from American Banker, and it's from October 15th, so very recent. So I'll go through it, what's going on right now as it pertains to Libor and SOFR. It says, banks brace for big bang, switch on 80 trillion worth of swaps. So this is not even the whole thing. This is just part of the derivatives market, because I think there's a lot more, of course, than 80 trillion worth of swaps. So let's go through this article. It says it's being called the Big Bang, and it has derivatives traders on high alert. In a critical development in the global shift away from old benchmarks that was triggered by Libor's shortcomings. I think it was more the scandal in Libor. I wouldn't put it past the bankers to have scandals with the new reference rates. I think it's all about the honesty of the bankers, which is very lacking, I would say, when things get volatile, so to speak, like in '08. Anyways, interest rate swaps on more than $80 trillion in notional debt will transition this weekend to a new rate for determining their value, while the switch to the secured overnight financing rate, or SOFR, that's the other thing as well. Libor could be overnight as well, but could also be 1 or 3 month or 6 month or 12 month. The SOFR is only overnight, and that's a problem. That makes it harder for the people who write these contracts to embed a synthetic, let's say, SOFR with a 1 month, 3 month, or 6 month, or 12-month maturity. That's the other problem. Is expected to boost longer-term liquidity in the new benchmark. It also is fueling concerns about unruly price action, because it is expected to trigger the sale of swaps on tens of billions of dollars of debt. The Big Bang is one of the most important steps in the Libor transition, said Marcus Burnett, director of SOFR Academy, an education technology firm whose clients include banks and asset managers. We expect rates desks from the largest banks in New York to be participating. The reset, which will see SOFR replace the effective federal funds rate in calculations that value swaps, is part of a push to make SOFR a standard U.S. reference rate in debt and derivatives markets. SOFR is intended to replace dollar Libor, which still underpins hundreds of trillions of dollars of assets, such as mortgages in the U.S. and syndicated loans in Asia. So it's still around and is supposed to be phased out by next year. They're having trouble with this. The Big Bang follows a smaller scale pivot in Europe this July, a less complicated switch that occurred without much impact on the market. Interest rate swaps allow two parties to trade one stream of payments for another over a set period of time. The most common variety, known as a vanilla swap, involves exchanging payments from a fixed rate for payments from an adjustable rate that is based on Libor or some other reference rate. Another kind, known as a basis swap, involves two adjustable rates. While SOFR has struggled to gain traction since its introduction in 2018, analysts say that the upcoming Big Bang has already triggered a shift toward more trading in SOFR-linked swaps. This could help pave the way for a curve that reflects expectations for where the rate will be in the future, addressing one of the new benchmark's key weaknesses. The Big Bang will have a very, very good impact on liquidity, says Jason Granite, Chief Libor Transition Officer at Goldman Sachs Group, Inc. Still, in the immediate future, there will be turbulence in pricing. Clearinghouses are planning to effectively neutralize the changes in swap values caused by the Big Bang, and traders will see their positions automatically adjusted. LCH Limited, which is London Clearinghouse, and CME Group are preparing to distribute compensation from clients whose provision values go up to those who see them decline. LCH will facilitate payment of hundreds of millions of dollars in cash to cover lost value and at least tens of billions of dollars in basis swaps to compensate for risk, said David Horner, head of risk at SwapClear, which is part of the London Clearing House, or LCH. However, some firms do not use basis swaps to hedge their discount rate risks or are otherwise incapable of keeping them on their books, so they are expected to sell them. This Friday, LCH, was yesterday, will hold auctions in which 18 banks can close out $25 billion in unwanted basis swaps. Buyers ideally would snap them up either as hedges against risk or for their own value, but the approach is largely untested since basis swaps were not distributed in the European version of the Big Bang. For about 6 months, our members and clients have been able to look on their screens and see a forecast for the compensating cash payments and compensating swaps they will receive, so they're familiar with what's about to happen, said Horner. It's important for the market that it runs smoothly. So it looks like they've been working on this transition and that things will be okay, but you go to the end of the article, it says firms need to understand they are facing more risk from this change first before they eventually get less risk, said Peter van Vredenburg, a principal of Market Alpha Advisors and previously a member of the Alternative Reference Rates Committee, which is guiding the US Libor transition, when he worked for HSBC Holdings in 2016. And this is what he said, though, at the end here of the article. The big banks are very prepared for the Big Bang. But do I think the smaller banks are ready for this? Not even close. When it comes to the overall switch to SOFR, he said, there are so many nuances to the transition and the devil is in the details. There's nothing simple in all this. So that's what it's all about. It's a transition from one reference rate to another. So they're not really transitioning from something that is very similar to Libor, and I think that's a problem. Will it cause a banking crisis? I don't know, but the best way to be insured, if there is a banking crisis, is not to be in the banking system, or to be in the banking system in a way that doesn't hurt you if there were to be troubles. But I suspect if there are troubles, we're going to get a lot more QE, a lot more programs, And that will mean more and more debt, a bigger balance sheet for the Federal Reserve and other central banks, and more currency debasement. And you'll be very happy you've been stacking, if you have, of course, gold and silver. Hopefully this video has helped you understand a little bit Libor, the derivatives market. And that's why Libor is so important, because the derivatives market has become such a huge bubble. It's like the tail wagging the dog of the economy, so to speak. And it's very risky, mainly because it's off balance sheet, all these derivatives, and they're highly leveraged. So when Goldman Sachs or a multinational or asset manager buys into these derivatives, they'll put, let's say, $1 million down, and they'll control 10 billion worth of notional amount. And that's why they're risky. That's why we could have accidents. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. Make sure you hit the little notification bell to be notified of all my new videos. And you can also follow me on Twitter, Facebook, and all these other platforms below here. I wish you all a great weekend. Take care. Bye.